Well, hey there, everyone. Happy Monday, November 3rd, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast and rainy classic fall day here in Redmond, Washington. Hope you guys had an enjoyable weekend. Keller family, after a successful Halloween trick-or-treating extravaganza on Friday evening, had a soccer-filled weekend around the Pacific Northwest. Lots of wetness, lots of moisture, lots of good soccer played, but an enjoyable one. Also, my Buckeyes pulled off a dramatic victory over the Penn State Nittany Lions, which we're thankful for as well. Thanks so much for joining me here on the show. I'm here at the Stock Charts office, meeting with some of my Stock Charts friends, talking about all sorts of fun things, and happy to be bringing with you some charts and observations. Now, if you followed our show last week, we talked about the earnings season, obviously front and center last week. This week, still some earnings. We're kind of getting toward the end of this Q3 earnings season here, first week in November. We did finish the month of October. I would argue the market's kind of whimpered into October. While we did see new all-time highs on the S&P 500 for sure, and we're getting closer and closer to that important 7,000 level, where I agreed to play the trumpet on the show. Not quite there yet, but getting ever closer here with a slight update today. What we talked about was the lack of follow through, right? I mean, the markets in October, particularly in the second half of the month, were marked by stronger price action, but weaker breadth, weaker momentum, weaker volume, weaker finishing, I would say, from the mega cap growth stocks, right? If the conditions are good, and if we should be all bulled up and optimistic about the markets between now and year end, I would argue the Microsoft, Meta, Amazon, Apple, NVIDIA trade should be accelerating, right? And the strength in those names ideally brings other optimism in other places too. And you're seeing random pockets of the market like aerospace and defense and industrials, like some banks like Bank of America making new highs in October. But there are a lot of things that are nowhere near new highs, and that's reflected in the weaker breadth conditions. Number of stocks, Amazon is very much the outlier, gapping higher and accelerating higher even today, making another new high. But for every Amazon, there's an Apple or there's an Alphabet gapping higher but kind of trading lower, and that lack of follow through is concerning because if the mega cap growth stocks aren't working, what exactly is going to propel this market onward and ever upward, as we like to say? Let's look at the market conditions here. That's enough of an intro. The format of the show, no change. We're going to do a brief market recap focusing on some of the key movements today and hopefully highlighting some things you may have missed, reinforcing things that you may have seen that we want to stress the importance of. We'll look at the heat map, which helps us just assess themes and sector plays and individual stocks showing unusual strength or weakness. And then I've hand-selected some charts to share with you toward the end. As always, we're here to answer your questions. On Friday, we did an all-mailbag episode highlighting some of the questions we've received from people like you watching the show in the last week. Please keep your great questions coming. The mailbag is always hungry for a new question from you and your fellow viewers. Look forward to answering your questions in our next mailbag episode set for this Friday. All right, so what happened in the first trading day of November 2025? Well, the S&P did finish slightly higher. Close was at 68.52. That's up just 0.2% from Friday's close. It was a choppy session. You can see we opened higher. We actually, in the first hour of trading, made it undercut the open, undercut Friday's close. Ended up rallying back around lunchtime, and then the afternoon was quieter, limping into the close, enough for the S&P to up 0.2%. The Dow was about 0.5% lower. The NASDAQ was 0.5% higher. So this is a kind of classic growth-led bull market configuration. The NASDAQ up, the Dow down, the S&P kind of neutral in the middle. That's basically what happened today. Mid caps and small caps mixed. Not a big movement day in either place, but the S&P 600 small cap index actually opened up quite weak, and through the course of the day actually pushed higher. That's actually an important, might be an important detail to keep in mind as this week progresses. Volatility lightened up a little bit. Friday, the VIX finished around 17 and change, not too far from where we ended the show ended the session today. Friday was around 1750. Today more around 1720. So still a low volatility environment with a 17 handle. But overall, certainly something to watch. I mean, a big red flag would be a spike in volatility out of the open. The VIX did spike up to almost 19, but settled down into the afternoon, keeping in that kind of 16, 17 range. That's low volatility. All right, rates are generally moving higher. We've been tracking that with the 10-year Treasury yield, with the long bond yield both pushing higher. The 10-year yield finished today around 4.1%. The long bond yield around 4.7%. That's about 1 full percent, 100 basis points above the 5-year yield, which finished the day around 3.7%. Interest rates have been rising. Interest rates rising. We highlighted last week, I think on Thursday or Friday's episode, what that tends to mean. But I mean, the general, when you have something like rates moving up, like what does that tend to do? There's sort of certain sectors and themes that tend to do better or worse with higher or lower rates. And it's something I keep in the back of my mind. I would never have that define my investment strategy. I'm going to look at the charts primarily and make sure that I'm investing with the trends that I'm seeing on those charts. But it's worth noting that when rates go up, tends to not be good for home builders, is the most obvious one, right? It's getting more expensive to take out a mortgage on a new home if rates continue to trend higher. And rates generally since May have been in a primary downtrend of lower highs and lower lows, but certainly have been turning higher in the last couple of weeks. There are other sectors and themes. We'll try to highlight those through the course of the week. If we see further appreciation in rates, bond prices generally moving lower today. The TLT was down about 0.25%. The dollar, not much of a change from Friday, and I think a stronger dollar here would be a big warning sign given where we're at, and given that what that would most likely mean about investors going to the safe haven that I think is still generally thought of as the U.S. So stronger dollar here, given the run that we've had in risk assets, would I think be a warning sign. We'll see if that plays out. Commodities generally doing okay today. You can see crude oil prices were slightly higher. Energy didn't have a great day relative to others, but natural gas in particular was up. You can see gold slightly higher, silver and copper prices lower. I did grab the chart of the GLD just to focus on gold prices. Pulled back, and over the last week, it's really sort of consolidated around a fairly expectable area of support, what we call a support range. So for now, gold's still hanging in there okay, and I still have a pretty decent bet in GLD and IAU because the chart is still telling me that that's A-okay. I tell you what's not looking okay today, cryptocurrencies. We highlighted last week some of the concerning movements we're seeing in cryptocurrencies, particularly looking at Bitcoin threatening its 200-day moving average. Over the weekend, Bitcoin did get up to around 111,000, but as we're following the equity session today, generally trending lower. Bitcoin's currently below 107,000. That's down 3.5% from basically Sunday's close. But if you look down through some of the other top coins on the stock charts platform, the further away you get from Bitcoin, the further you get down into sort of those altcoin spaces or less common, but still fairly widely known. A lot of red today in some of these like Solana, Chainlink, Kronos, Litecoin. And if you're not familiar with those are the cryptos that aren't Bitcoin and Ethereum, which are the two most widely followed and the one fairly well understood and known, I guess, as best as could be expected. But Ethereum, which is also a pretty widely followed crypto, accelerating to the downside. I mean, just today has gone from 3,900 down to 3,600. That's a big swing. These are big movements that we're seeing across the board in the crypto space. It's almost like Bitcoin is holding up better than the rest of these coins that we're tracking. Some of the more common coins. Certainly a vulnerable area of the market to look at. I grabbed one of those Bitcoin ETFs, and I forget which one it is, so I'll remember when I show you the chart here in a little while. But a space certainly I'm watching, and to be clear, I own a number of different Bitcoin ETFs. I've been lightening up on those here in the last couple sessions. All right, looking at the 11 S&P sectors, kind of split here, right? 5 up, 6 down. You can see the consumer discretionary sector, XLY, up 0.9%. Technology, number 2, up 0.4%. Everything else basically flat to down today. On the downside, communications services, down 1.1%. Consumer staples and materials, both down over 0.5% as well. So we're back to consumer discretionary and technology, which are really the only two sectors that have had any opportunity to outperform recently. Technology has been the strongest sector in the last month, not even close. Consumer discretionary, I think a close second probably. Certainly in the last week, consumer discretionary with the strength in Amazon, gapping higher, going even higher today. Tesla, which looks like out of all the Magnificent Seven charts, who would have guessed it? Tesla, probably the most constructive technical configuration, I would say at this point. Worth noting, besides the ones that are just breaking out and gapping higher, but Tesla's sort of just a nice consistent uptrend. All right, looking at breadth, we've highlighted here in recent weeks how the breadth conditions have been very underwhelming, and I don't think any real change to that. On the New York Composite Index, 56% stocks down, 42% of stocks up. On the S&P 500, almost a 2-to-1 ratio, 63% down, 37% up. A little better when you get smaller. So we talked about the S&P 600 actually was up today. 55% of the S&P 600 members, it's a small cap S&P benchmark, were up today. So broad decline continues in the NASDAQ Composite, in the S&P 500, certainly in the New York Stock Exchange as well. If the market has a significant sell-off here in Q4, which, don't get me wrong, is not common, but hasn't happened before, it definitely has, right? If you don't have to go that far back, less than 10 years back, you can find a good year, 2018. I have a whole charting platform here. Why don't I show you? I'm pretty sure it was 2018 is the year I'm thinking of. Let's look at a weekly chart. Let's go basic chart. Let's go back around 15 years and let's look at weekly data. 2018, that's what I was thinking of. 2018 is probably the most obvious example I can come up with within the last 10 years where we had a really rough Q4. But if you look every year, starting last year and then going back, the fourth quarter, which is like this last, section before the big thick line, which is the end of the year, has been fairly strong. Now, a lot of times that's because we had a pretty significant pullback in September and October, which is also quite common. But even in the COVID year in 2020, we had strength. In 2019, we had a strong Q4. 2017, 2016, 2015. It's almost every year was like that. The only year we didn't was 2018. 2018 was actually where the first quarter was pretty rocky as well. We had a major low in early April, which may sound very familiar because that's sort of what happened in 2025. But again, sort of October started and the market sold off and ended up making a major low in December. I'm not going to tell you that that's what I see as the parallel here. I'm just saying it's very rare that you have a super weak fourth quarter, but that's something that is on my mind because the problem here is we have the Hindenburg omen that fired. For me, that tells me look for signs of deterioration in price. We've got weaker breadth, weaker momentum, weaker volume. And as long as those things continue, there's just not a lot of accumulation happening in the broad indexes. And then the question is just how much can the major benchmarks go up, driven almost exclusively by mega cap growth stocks, making AI deals with one another and continuing to sort of get all the chips in their big piles and growing piles. The answer is it can go up quite a lot and quite further than many certainly expected off the April low, but it's happening here. So weaker breadth, I was taught was not a good thing, and that's continues to be what I'm seeing here. Now, the Magnificent Seven stocks kind of mixed today, and we highlighted that last week, right? Most of these companies reported earnings last week. Very few of them. Amazon is kind of an outlier, gapping higher and then continuing higher. So today, Amazon up 4%. Tesla, as I mentioned, kind of a nice accumulation phase, up 2.6%. NVIDIA up over 2%. Then you're down to Alphabet, which did gap higher last week and closing slightly higher. But then the rest of these really breaking down and not horrible charts yet, although arguably Meta is almost probably a horrible chart at this point, below its 200-day moving average and continuing to be in a bit of a free fall. But the rest of these have kind of been holding up. But the question is, if we continue to see rotation at some point, that really weighs on our benchmarks, which are dominated by this small number of names that you see here. It's just an outsized weight on a lot of those names. All right, we're going to go to the heat map here. As a reminder, I appreciate all of your questions We're doing the show recorded now, and I appreciate it. It gives me a lot more flexibility, but also gives me the opportunity to answer your questions as they come in. So please, on our YouTube channel, use the comments section to ask any and all questions. Would love to hear from you, and hope to answer one of your questions in our next mailbag episode, which will be on Friday of this week. Looking at the heat map, not a particularly good day, particularly if you block out Amazon and Tesla, top middle of your screen. If you block out Eli Lilly, bottom middle, which is a healthcare stock showing a remarkable amount of strength here, almost looks like a growth stock here. If you block out NVIDIA and Micron and Palantir, now granted, I just blocked out like 6 or 8 stocks, but the problem is those are the only ones really showing a lot of strength here. After that, looks like a pretty rough start to the week here, right? And there are very few sectors, even with the sectors that I mentioned, right? Consumer discretionary, Amazon and Tesla had a fantastic day. But after that, you've got some gambling names like Wynn and Las Vegas Sands. Las Vegas Sands actually making a new 52-week high today. Kudos for the nice breakout. But then you've got, cruise companies breaking down. Here's RCL making a new 3-month low today. You've got auto parts stores like O'Reilly breaking down, accelerating to the downside. You've got Nike failing to hold any sort of breakdown. And so, some of the Lululemon has been an ugly chart for the entirety of 2025, but some of these have been really good charts until they really started to roll over. And, O'Reilly is maybe an example when I talk about a change of character in these markets. Through the end of September, the S&P and the NASDAQ are moving higher, and there's a bunch of O'Reillys that are in primary uptrends, making higher highs and higher lows. O'Reilly's now below its 200-day moving average for the first time since the summer of 2024. And I know O'Reilly is not the biggest stock or the most important stock in our benchmark, but it is in the consumer discretionary sector. And that's a sector that did quite well today. But as you can see, the XLY did quite well because Amazon and Tesla are up a ton today. If you take that out, if you look at an equal-weighted version of the consumer discretionary sector, it's kind of a rough day. And that sort of, juxtaposition of strong indexes, strong ETFs, but it's, but weaker breadth, right? Weaker support for those moves is really a danger sign, right? And again, this could resolve higher if a bunch of these names just start to recover. This market could see improving breadth and improving momentum, but I'm not seeing that now. I'm seeing more signs to be skeptical of new highs here as we threaten S&P 7,000. Sectors like industrials, which have arguably been some of the better areas in the market, not having a particularly good start to the week. We'll see how things play out here, but even aerospace defense names not looking particularly strong generally today, certainly not to the degree that we've seen in recent weeks. Healthcare also a very mixed sector. Financials, very few things going higher, and even technology, right? I mean, you can see within a sector that has NVIDIA and Palantir and Micron all having really good starts to the week. You also have Motorola, you have CDW, you've got Super Microcomputer, Broadcom, Oracle, all having some decent pullbacks today. So very much a mixed results start to the week. Again, it seems very clear there are a small number of stocks still doing quite well, but forever NVIDIA, pushing above 200 and just showing that the sky's the limit. There are a number of things that show that look very vulnerable, and I think that's certainly an issue here. Other random group to highlight would be the hard drive makers, right? Western Dig and Seagate. These stocks are both making new 52-week highs, new all-time highs in the last week. Western Digital essentially gone vertical here, accelerating to the upside, higher highs, higher lows. And again, in a chart that's extended like this, I often get questions about what do you do with a chart that's like this. And again, I would assume that a trend like this is innocent until proven guilty, right? I'm going to assume that trend should be followed until the chart tells me it no longer deserves a place in my portfolio. So what does that mean on a chart like this? The 21-day exponential moving average is kind of my go-to. We can see a number of times where that has held beautifully, most particularly here in the last couple of weeks for Western Digital. The other thing would be a trailing stop indicator like the chandelier exit system, which is based on average to range. Those are the kind of things that help you, I think, have peace of mind and confidence with an uptrend that is lasting a lot longer than you think it should or it could. Selling too early, nothing feels good about selling when something is up 20% and then standing there on the sidelines as the stock goes up another 200% after you sold out, which is why I'm not a big fan of selling a lot when something's up a lot. I'd much rather trim a bit, but then, try to follow that trend as long as possible. Become a trend follower. Charts like Western Digital, I think, are still followable trends, right? The chart will tell you when the trend is no longer up. I'm not seeing that today. I think that's it for the heat map. By the way, as we're looking at some random names and talking about, charts like the previous one and how to approach them. Western Digital was the name. Just wanted to remind you, our next live Q&A will be happening this week on Thursday, November 6th, 1:00 p.m. Eastern, 10 a.m. Pacific. We're calling it Ticker Tantrum. We have done this show, Chart This with Dave Keller, live. We're actually pivoting to do it recorded here for a little while, and thought it'd be really cool to have a separate live Q&A where we could focus on the chat and really answer questions of tickers that you're throwing around, charts that you're struggling with, things that you're wondering how someone might approach it to give you a second set of eyes on a chart of interest. But of course, any and all questions are going to be welcome. It's going to be an open discussion. I will have some charts prepared to start off with. You can sign up for that free event at marketmisbehavior.com/ticker. And you can have you can confirm all the details on that page as well. That's the same link you're going to use to join the webcast this coming Thursday, November the 6th at 1 p.m. Eastern. If you've watched the show and followed my work, I certainly hope to see you at that live Q&A. Should be a lot of fun, and I'm looking forward to it. All right, let's look at some charts together, shall we? Here is the daily chart of the S&P 500. We drew this trend line channel last week, kind of liking it because I think it's a pretty good, sort of reference to how the market is going. Trend channels are the kind of thing that you don't always use them. As a matter of fact, oftentimes a chart does not look like a trend channel would be appropriate. Excuse me, so sorry. That's how you can, you don't always apply trend channels to a chart. Sometimes the configuration is not quite right, but if you've looked at enough charts, every once in a while you see it and you go, yep, that looks pretty much like a parallel channel of higher highs and higher lows. And when I draw this trend channel on here, these thicker green lines that you see going back to the end of June, I'm not saying that's what's going to happen forever. And I'm not necessarily saying this is a trading system where I'm trading this channel. For me, it is a visual representation of the pace of the advance. This is how quickly the S&P is appreciating on average from 1 month to the next. And I always like to highlight, I look for what are called changes of character, right? I want a chart that looks a certain way and then recognize when it looks different. And for me, a trend channel is helpful because at some point, one of two things is going to happen. Either we break above the upper boundary, which tells me the trend is accelerating. That often coincides with overbought conditions. That can often indicate we're leaning too far over our skis and probably are due for some sort of pullback if we get overextended. The other choice would be we rotate below the lower trend line, and that tells you that uptrend is now very much in question. So the trend line, the trend channel that I'm drawing here, really helpful for just identifying extremes in either case, right? When the market gets overheated, we push above the upper boundary. As long as we remain within these boundaries, the trend is kind of consistent, and we can have up and down days within that channel, but that channel kind of defines for me what this market has been for the last 4 months. I think this is an important one to watch. We'll keep this on the chart here for now, and we'll certainly make some noise when it breaks out of that channel, because it will at some point. It will not continue in its current pace and current form forever. At some point, it's going to change. And if we would break through there and break through the 50-day moving average, 65.50 still, for me, is the line in the sand that I am watching. I would encourage you to do the same. Breadth conditions have gone from good to bad to worse to even less good today. We are currently at 39% of the S&P 500 members remaining above their 50-day moving average. That means most of the S&P have not held their 50-day. The S&P is still well above its own 50-day moving average, but most stocks that comprise that index are not. That speaks to the weakness that we're seeing kind of underneath the hood of the markets. The long-term breadth is still okay, but getting very, very close to not okay. 50% is that threshold that I've always paid attention to. We last had that bearish rotation here in early March, soon after the February market peak, where the percent of stocks above their 200-day broke below 50%. If the Hindenburg omen that we shared with you last week, if that plays out as the indicator would suggest, which means we are near significant drawdown of some form, or some sort of corrective move, indicators like this getting below 50% would be a big check on that was probably a major top list. It's not there yet, but certainly something to monitor. Other breadth indicators I follow, like the bullish percent index, which is a breadth indicator based on point and figure charts, have already broken below the 50% line. Now, here's the thing, and this is what's happening in the markets here in November of 2025. We are at 48% of S&P 500 members in a bullish point and figure configuration. But if you look at the same indicator on the NASDAQ 100, it's still above 60%. It's around 61%. So that gap from like 49% for the S&P, 61% for the NASDAQ 100, that's because this is the growth leadership, right? These 100 big mega cap, large cap technology, communications, consumer names that are in the NASDAQ 100 still look better as a group than the S&P 500. And so the breadth here is showing you the leadership that's still there. This is what is keeping this market and keeping the major indexes elevated to the point that they are, which also means any breakdown in this indicator in particular tells you that the music has stopped, mega cap growth no longer working to the degree that it was, and that would be a big red flag for the NASDAQ for sure, but also I would say for the S&P 500. All right, to talk about gold, here's how I'm thinking about this recent drawdown. We'll get back to the RSI in a second, and this is the GLD that I'm showing you. Full disclosure, I do own GLD in my own accounts, and I did trim some of the position here on this pullback, particularly when we broke below the 21-day EMA. I don't just throw things out that like that I use the 21-day EMA as a trailing stop. I actually legitimately do in my own trading, which is why I lightened up some of my position when we broke below the 21-day EMA about a week ago. What's interesting is we've currently bounced off of the 360 level, and if you take the low, that's from May, when the GLD bottomed out just above $290 a share. It got up to above 400, and that was mid-October. It then pulled back and retraced 38.2% of the way back down to that May low. So here's 38.2%. You can see that lines up very, very well. Now we've bounced up to the 21-day moving average. So the bull scenario from here, obviously we need to regain the 21-day EMA. That would set us up for a new retracement back to those previous highs, or at least be in more of a position of strength. But if we're unable to get above there, and if we would break below 360, that's where I have an alert set, and I would encourage you to do the same. I'm writing that down just to make sure. I'm pretty sure that's where I set the alert, but I want to make double certain that I did. Gold GLD below 360 all of a sudden is a very broken chart because we're bouncing off of the first Fibonacci retracement. It's not holding. So far, we're seeing some buying power come in at that first area of support. But if that doesn't hold, that would be an issue. I'd also be looking at the RSI. The RSI has been above 40 since the fourth quarter of last year. And if that would change, right, if we break down and the RSI would push below 40, that would be a big danger sign for gold. For now, holding up okay. Shout out, by the way, to one of my Market Misbehavior premium members. We have an ongoing dialogue, all of us as a community, and our member community. It's an online platform where premium members can ask questions. That's where I post all my member-only content, like our weekly flight plan and our monthly chart review. All of our virtual courses are accessible through that platform as well. All of that benefits for premium membership. If you want to learn more, by the way, go to marketmisbehavior.com/premium. As a reminder, use the code YouTube when you check out for 30% off your first 12 months on any plan. It would be great to have you as a premium member if you followed my work and enjoyed the show. We've got a lot more to talk about with our premium members for sure. One of my premium members was asking about soybeans. And so I was sharing some charts and insights with them. This is the Tucrium soybean fund, which has just broken out and made a new 3-month high. One of the scans that I run regularly are stocks and ETFs making new 3-month highs and stocks and ETFs making new 3-month lows. I love this one that showed up on that screen. as we're looking for ETFs breaking out to the upside, and particularly the fact that we've gapped above that resistance from August and September, also June, also May. Look how many times we tested that, like 222 and a quarter, 2250 range, a number of highs, and then this was finally something different. We're overbought right now. And before you think, uh-oh, is that a bad thing? It is not. If you look back at a bunch of charts, when we have a consolidation phase, right, a sideways trend, when you finally break out, you really need to see overbought conditions. You need to see strong momentum on that breakout. That's when a breakout is usually to be trusted, because you have strong upside momentum, which represents big accumulation on that breakout. And I'm seeing that on soybeans, which is pretty encouraging. Not as much in some of the other soft commodities, but soybeans definitely standing out here. Let's talk about Bitcoin. At GBTC, I do own this ETF. I also own some IBIT, although I have been trimming some. I own a number of Bitcoin ETFs. I've been unwinding some of those positions here, given the short-term weakness, given the fact that Bitcoin's below its 50-day moving average. For me, that's enough to lighten up a little bit. The GBTC is really in no man's land between, the 50-day moving average above and the 200-day moving average below. And I'll tell you what this configuration makes me think. I immediately go in traffic light mode. And this is what I mean by traffic light mode. I would encourage you, when you see an ETF or a stock between two extremes, you go full traffic light. All right. If we can get back above the 50-day moving average, if we can clear that late August peak, that's a positive breakout. That would be a consolidation at the first Fibonacci support, which is just above $82. We would have held the 200-day moving average. Breaking back above the 50-day would be a really positive resolution to this pattern. On the other side, if we would go down this way, which would be a breakdown below, we'll call it 82. That would mean a failure to hold that mid-October low, a failure to hold the 200-day moving average, a failure to hold the first Fibonacci support level. We break below that, I don't see a lot of great technical reasons to continue to own that ETF, because we've broken down through support. And then that also means this kind of region in the middle, that's your neutral region, right? If we're between these two, and if I have like unlimited time, I would really make sure that these are beautifully drawn, but I'm gaming it just for time here. Can I do, no, yeah, I can't do this without breaking something. All right. So I'll just show you this general, here we go. Select that guy, make it there we go. This is close enough for now. Right? So between the moving averages, we're in no man's land. We break down below 82. That's a bearish chart. We break out above 90. That's a really encouraging chart. In the middle, we're sort of in neutral positioning. And so this is how I would approach this particular chart. Certainly in a trading account where you're playing swings, I think breaking above or below those thresholds, as we talked about, could be very, very meaningful for what's going to happen next. That'll tell you the direction of momentum very, very quickly. That's what I'm seeing with the chart of GBTC. So I still own a decent position here, and would definitely start unwinding it if we would break below the 200-day moving average. No guarantee that downtrend continues, but there's enough of a risk that I'm happy taking more and more off the table. I just want to show you this chart, offense versus defense. This is looking at comparing, consumer discretionary versus consumer staples. It's a comparison that I use often. The top half is the cap-weighted version, and we can see how it's accelerated here in the last couple of weeks. This is the equal-weighted version. Why is there such a difference where the cap-weighted version has already made new 52-week highs and the equal-weighted version still below its September peak? The reason is because the cap-weighted version is dominated by Amazon and Tesla, both of which have had a pretty good couple weeks here, particularly the last week, with Amazon beating on earnings and continuing higher, leading the Mag 7 names by pushing higher again here on Monday, November 3rd. So a lot of times these two ratios move almost the same because they're tracking the same set of stocks, but depending on how the mega caps are doing, these can become disconnected a little bit. The fact that the equal-weighted version is not broken out yet, I see as a cautionary sign, as opposed to being all pulled up because Amazon and Tesla are working. I'm more concerned by the lack of performance in the equal weighted version of that ratio. Looking at the chart of Tesla, good chart. It's a good chart, right? And compared to the other Magnificent Seven charts, it's an exceptionally good chart because we're not overextended. We're just threatening to break above those highs from early October. That was when we had this bearish engulfing pattern, which was so clear on the chart of Tesla. We've bounced off the 21-day EMA, excuse me, making a new attempt at a new 52-week high here very, very soon. Boy, back in June, July, August, talk about a classic example of a symmetrical triangle pattern. That breakout and retest and follow through, pushing above the 200-day moving average. Looking back there at this point, I mean, what a perfect example of looking at price patterns, waiting for confirmation, using moving averages and other techniques to validate those movements. I think that's a great example of the benefits of the technical analysis. All right, what's the danger to this market? There's a lot of things we could talk about. But from a technical perspective, I would say it's the Mag 7 names. It's the leading growth names struggling. Meta, which is the top panel of these three charts, has already gapped below its 200-day moving average on Thursday of last week, lower on Friday, lower again today. The middle panel is Netflix, which on Friday closed back up to the 200-day moving average. Today opened higher, closed lower. Still not breaking down a ton, but unable to regain footing above the 200-day moving average. This is the risk. Now, other names like Microsoft, nowhere near their 200-day, gapped higher, but trading lower. So we had this nice gap higher last week, but now we've gone all the way back to where we were before that gap. So any optimism that was baked into the price around the previous week, around earnings, all given back. And the last 5 sessions, we've closed near the lows of the day. The risk to this market is, I would say, the weaker breadth has been a red flag. A nail in the coffin to this bull market would be leading growth names accelerating to the downside. The more of these breakdowns that I see, the less I think you can be comfortable and confident about further upside for the S&P and the NASDAQ. Last chart I want to share with you, Disney. I'm here in the Stock Charts studios because we were just recording earlier today. Grayson Rose and I, with the help of Skybogs and the SCTV team, we were recording our top 10 charts to watch for November 2025. I will share with you a quick preview. Disney is one of mine, very similar to the chart that we saw with GBTC, sort of in no man's land between the 50 and 200-day moving average. Talk about that traffic light technique. I think the same thing very much in play for charts like Disney. This could resolve higher or it could resolve lower. This is the kind of time where you wait to see which way it resolves and what the momentum looks like as the chart resolves that breakdown or breakout. Folks, that'll do it for today. Thanks for joining me here on Monday, November 3rd. Don't forget to check out our Ticker Tantrum, our next live Q&A coming up this Thursday. You can sign up at marketmisbehavior.com/ticker. It is a free event. I would love for you to join and ask questions as we go. We'll have the chat going. We'll have a good discussion and debate and throw around a lot of tickers together. I hope you will leave there with a bunch of compelling charts, actionable ideas, and reinforcement of some of the tools and techniques we talk about on the show. For now, I'll say have a wonderful Monday evening. And remember, it's always a good time to own good charts. Take care, folks.